Hello and welcome to our 10-minute property tip series. Today we will talk about the back of the cigarette box calculation in property investment. My name is Nigel Adriaanse, the Chief Empowerment Officer at the EDPF Academy, and today we'll explore how this simple yet effective calculation can help you evaluate property investments quickly and easily in order for you to immediately decide whether you would make an offer to purchase a property, subject to certain terms and conditions, of course. In this presentation, we'll cover what the back of the cigarette box calculation is, how to perform it, and why it's important for property investors. We'll also delve into its practical use for those looking to start their journey in property investment. The goal is to give you a clear understanding of this method and its applications. The term back of the cigarette box calculation refers to a simplified method used to quickly assess the viability of a property investment. It's called this because, just like doing a quick calculation on the back of a cigarette box, it provides a fast estimate without requiring extensive data or complex formulas. The main purpose of this calculation is to offer a preliminary gauge of a property's rental yield. This can help investors swiftly determine whether a property is worth further consideration. To understand the calculation, it's essential to grasp the key components of property investment. First of all, rental income. This is the gross income you receive from renting out the property, which can include potentially operating and municipal recoveries as well. The purchase price, the amount paid to acquire the property, possibly also adding in then transfer costs and potential renovation costs. Then expenses. This includes property management fees, maintenance costs, and local rates and taxes and other municipals. Then finally, capital growth, the increase in the property's value over time, although this isn't directly factored into the cigarette box calculation. So let's explore the formula for the back of the cigarette box calculation, which is quite simple. Here's how it works. You first determine the annual rental income from the property. Next, you identify the purchase price. Divide the annual rental income by the purchase price, then multiply that result by 100 to get the rental yield percentage. Let's break this down. Annual rental income is the total rent you collected in a year. Purchase price is the cost you paid for the property, and multiplying by 100 converts the ratio into a percentage, making it easier to interpret the yield. For example, if your property generates 100,000 Rand in rental income annually, and you bought it for 1 million, you would calculate the yield as follows: 100,000 divided by 1 million multiplied by 100, giving you a 10% yield, indicating that it generates 10% of its purchase price annually in rental income. So how do we interpret this? What does this yield percentage tell you? A high yield suggests a better return on investment relative to the property price. For instance, a yield of 10% is considered strong and may be attractive in many markets. To determine if a yield is good, compare it against average yields in your market. For example, in South Africa, a yield of about 8% is generally seen as appealing in the property sector. So why is it important for you to do this calculation? The back of the cigarette box calculation is valuable because it offers a quick assessment tool. It allows you to swiftly evaluate whether a property meets your basic investment criteria before investing time in a more detailed analysis. This method helps streamline the initial screening process, making it easier to handle multiple investment opportunities efficiently. However, this calculation does have its limitations. First of all, it does not account for capital growth. It only looks at rental income and not potential appreciation in property value. Secondly, it ignores financing costs. It doesn't factor in mortgage interest or other loan-related expenses. And thirdly, it excludes tax implications. taxes on rental income or property value are not considered. These factors, however, are crucial for a comprehensive investment analysis. To get a fuller picture of a property's investment potential, you might consider additional metrics. For example, net yield. This accounts for expenses by using the formula annual rental income minus annual expenses divided by your purchase price times 100. The second one would be gross yield, often used interchangeably with our simplified calculation, but may not always include expenses. And then thirdly, return on investment. This considers both rental income and capital growth, calculated as net profit over the period of the investment divided by total investment, multiplied by 100, giving you the percentage of your return on investment. If you wish to know more about investment tools to calculate different metrics, please go to tip number 11 in the series. So, let's talk about applying the calculation for investment decisions. Here's how you can apply this calculation in your investment decisions. Number 1, when to use it. Use this method as an initial screening tool to quickly assess potential investments. Comparing multiple properties. Apply the calculation to different properties to find the ones with the most attractive yields. Then setting investment criteria. Determine what yield percentage meets your investment goals and use it to filter out potential property investments. In South Africa, rental yields can vary significantly by location. Major cities like Johannesburg, Cape Town and Durban may have different average yield rates. For instance, Johannesburg might offer yields of around 3 to 5%, while smaller towns could offer higher yields but with different risk profiles. Understanding these location variations helps tailor your investment strategy to the specific market conditions. Let's review the pros and cons of using this calculation. Two of the advantages are simplicity, it's easy to understand and use, and speed, which allows for quick preliminary assessments. The disadvantages are oversimplification. You may miss critical details about the investment, and exclusions. It doesn't include potential costs or benefits. While it's a usual tool to assess whether you would want to make an offer on a property, it should be complemented by more detailed analysis. If you're new to the property investment game, here are some tips or steps to get you started. Research the market. Understand local property trends and investment opportunities. Understand the calculation. Familiarize yourself with the back of the cigarette box calculation and its limitations. Evaluate multiple properties. Use the calculation to assess different properties. And then finally, seek professional advice. Consult with real estate experts and financial advisors to refine your investment strategy. When using the back of the cigarette box calculation, avoid these common mistakes. Over-reliance on simplified calculations. Don't base final decisions solely on this method. Ignoring other costs. Make sure to factor in management fees, maintenance and taxes. And then finally, not considering market trends. Stay informed about market conditions and how they affect property values and yields. These precautions will help ensure a more accurate assessment of investment opportunities. In summary, the back of the cigarette box calculation is a quick and easy method for assessing property investment viability. It helps with initial screening and comparing potential investments, but should be used alongside more detailed analysis. Understanding its limitations and integrating additional metrics will provide a more complete picture of your investment opportunities.
Thank you for being part of the EDPF Academy #1 Title Deeds project. We hope you will continue your journey to property ownership with us by registering for our Academy course at www.edpfacademy.app or visit our main site at www.edpf.co.ca for more information about EDPF.